Welcome back. In the last lecture, I introduced the concept of option pricing, the pricing of options after we discussed the stochastic process models based on Brownian motion. And I explained that the fundamental assumption or the fundamental premise on the basis of which option pricing is done is that we can construct a risk free asset comprising of the derivative and a counter position in the underlying assets. And I explained that because the source of randomness is the same in both cases, the volatility of one can annul the volatility of the other, and as a result of which the combination can be so constructed that the residual or the portfolio has no residual volatility. And therefore, because the portfolio has no residual volatility, it will generate the risk free return, and hence knowing the components of this portfolio, that is, we know the market pricing of the risk free asset, we also know the market pricing of the underlying asset, we can arrive at the implicit value of the derivative asset by the principle of no arbitrage. And that was the philosophy. Working on that philosophy, I moved on to the binomial pricing model. And while talking about the binomial pricing model, we talked about a new concept of probability. Now, this probability, which we termed as a synthetic probability, turned out to be risk neutral probabilities. Risk neutral probabilities, I reiterate, are not real life probabilities. They are not based on experiment and observation. They are simply mathematical constructs, but the constructs are such that they obey the laws of probability, and hence they are called probabilities. The important thing is that if we work out the expectation value of the stock of the underlying asset, not the derivative, the stock, with respect to these risk neutral probabilities, we find that this risky asset, the stock is, epitomizes a risky asset. Stock contains volatility, stock contains risk. Now, despite that fact, when we work out the expectation value of stock using these risk neutral probabilities, we end up with a risk free return on the stock. In other words, if you work out the future value of stock using the expected future value of stock using these risk neutral probabilities, you end up with S 0 e to the power r t, not e to the power mu t. Now, what is the implication? That is very important, that is very fundamental in mathematical finance. The implications are that all investors, irrespective of the risk of the asset, are willing to accept the same return, because you see there will be a number of risky assets of which this particular stock could be one available for investment in the market, and yet all the investors are getting the same return, let us call it R. For the moment, let us simply call it R. So, all the investors are getting the same return irrespective of the risk profile of the investments in which they are putting in their money. And that means that can only happen if the investors are entirely indifferent to the risk profile of the investment. In other words, the risk of the investment does not constitute a decision criteria for them. That was one thing. And the second thing we concluded was that this, because of the principle of arbitrage, this return had to be the risk free return, because if any asset provided a higher return in the market, notwithstanding the fact that it had a higher risk, people would continue to the investors will invariably invest in the risky asset, because it gives a higher return, and we are not concerned about risk. The investors are not concerned about risk. So, they invest in the risky asset, which enhances the demand for that asset, which reduces the demand for the risk free asset, and as a result of which the prices of the risky asset escalate, and that of the risk free asset goes further down, and the returns tend to normalize, they tend to equalize. So, the no arbitrage requirement would essentially imply that because this risk free asset would be the threshold return, because it has the lowest risk, it has in a sense the nil risk, and hence it would have the lowest return in the market, and all other assets, if they provide higher returns, would carry higher demand due to arbitrage, and consequently the process of arbitrage would result in the return coming down to the level of the risk free asset. So, the implications are, number 1, that the investor is risk neutral, and number 2, no arbitrage would imply that all investors would then invest at the risk free asset. They would have to be satisfied with the risk free asset. Market dynamics would operate in such a way that all investors would be getting only the risk free asset and nothing beyond that at equilibrium. At equilibrium, right. So, this is what we discussed yesterday, and we also arrived at the very important formula that the price of a derivative f 0 is equal to e to the power minus r t. This is the discounting. E of q, this is expectation value with respect to q probabilities of the payoff from the derivative at maturity. So, this was the very fundamental formula that we arrived at using the concept of one step binomial tree. Let us apply this, and then we also discussed why the real return of the stock becomes irrelevant, why the real probabilities become irrelevant. In fact, that is essentially because of the reason that we are not valuing the derivative per se, we are simply valuing a portfolio which has a payoff equivalent to the derivative. We have constructed a risk free portfolio consisting of the derivative and the stock, and we are valuing the risk free asset and the stock, and we are thereby arriving indirectly at the value of the derivative. That being the case, and because all the probabilities and all the information about the return requirements by the market, what the market wants from the stock, keeping in view its riskiness, keeping in view its upswing and downswing probabilities, are encoded in the stock price. The stock price epitomizes the entire market's perception about the probabilities. Therefore, the derivative is because it is being valued indirectly, does not require to be valued involving the real life probabilities, because the impact of the real life probabilities are captured by the stock, and we are really valuing the stock and the risk free asset, and thereby arriving at the value of the derivative. So, that is the reason that the actual real world probabilities do not play a role in the valuation of the derivative, because they have already played their role. They have already played their role in the market pricing of this underlying asset. Now, let us look at an example of the binomial pricing model, and let us try to interpret or analyze the implications of the pricing model. Let us talk about a call option. We all know that the call option, this is the formula that we have just talked about, and for the call option, the payoff f of s t is given by maximum of s t minus k and 0. This is the payoff of a call option, a European call option at maturity. So, we work out its expectation value and we discount it to today to arrive at the current market price of the derivative. Now, in the case of the one step binomial model, what happens? The stock price can take only two values. The stock price can take value S u, which is equal to u s naught, u is the percentage increase, or as the stock price can take the value S d, which is equal to d s naught, where d is the percentage decline. The respective probabilities, remember we are operating in the risk neutral world. So, the probabilities for the stock price going up is q u and the stock price going down is q d. Now, in this particular model, it has to be that the strike price will lie between the upper value of the stock and the lower value of the stock, that is, it will lie between S 0 d and S 0 u. Why is that? Well, if the exercise price is below S 0 d, then the option will invariably be exercised. If the strike price of the option is less than S0D, then the option will invariably be exercised, and that in fact it would take the character of the stock itself. So, it really does not carry any worth in terms of being an option. And if the stock exercise price is greater than S0U, what happens? The option will never be exercised, because you can get the stock at a maximum price of S0U. So, the option will never be exercised, and as a result of it, it will invariably have 0 value. So, we must have, in a realistic situation, this inequality must be satisfied, that the exercise price must lie between the upper value of the stock and lower value of the stock at maturity. Therefore, what happens to the option payoff? The option payoff becomes S0U minus k with probability QU, that is, if the stock price goes to the higher value, that is US0, then I get a payoff of US0 minus k, and the probability of that is QU. And if the stock price goes down or ends up at S0D on maturity, then I get the value payoff as 0, because in this case what happens? S0D is less than k, S0D is less than k, and therefore, the payoff will be 0, and the probability of that is QD. Therefore, the call price as of today will be equal to e to the power minus RT into QU into S0U minus k, and this 0 payoff will contribute nothing to the value of the call. If you simplify this, you get e to the power minus RT Q U into U S 0 minus e to the power minus RT Q U into k. Now, what is the expected value of cash outflow under the option? Now, at maturity what will happen? You will pay the exercise price and you will get the stock. So, the cash outflow will be equal to k, the exercise price, and that exercise price will be an outflow only if the option is exercised. In other words, and when will the option be exercised? The option will be exercised with probability QU, that is, when the stock finishes at at US0 and does not go downwards to DS0. Therefore, if the stock goes to US0, the probability for which is QU, your cash outflow on account of exercise price is k, and if the stock goes down to DS0, the probability for which is QD, your cash outflow is 0. Let us work out the probability of this, let us work out the expected value of this pair of events. We have QU into k plus QD into 0. QU if the stock goes up, and then I have a payoff of k, and it will be negative if I am the option holder, then this quantity will be negative, but for the moment QU into k and QD, if the stock price goes down, the probability of which is QD, the no exercise price will be paid, the option will not be exercised, and therefore, no exercise price will be paid, and therefore, the outflow will be 0. Therefore, the expected value turns out to be QU into k. Therefore, e to the power minus RT QU into k is nothing but the present value of the expected value of cash outflow under the option. This is expect cash outflow. Remember, we are assuming, or we are talking about the exercise price, outflow being the exercise price. In other words, we are being long in the option, and therefore, we are to paying the exercise price. And this is in a sense negative. What is the value of cash inflow? What will I get in return when I pay the exercise price? I will get 1 unit of the stock. I will pay the exercise price k, and I will get 1 unit of the stock. So, as far as the stock is concerned, what will happen? What will be proceeding absolutely similarly to what to the case where we talked about k. We work out the expected value of the cash inflow, because getting the stock is equivalent to getting a cash inflow of ST, because and ST is nothing but US0, because if it is DH0, the option will not be exercised. So, there is only one situation in which the option is exercised, in which case the stock price ST is equal to US0, and the probability of this is PU. In the other case, the option is not exercised, so there is no you will not get the stock. So, there is no cash inflow and the probability of this is of course Q of D. So, working out the expected value of this combination, we have the expected value of cash inflow, assuming that this U S 0 is realized in terms of cash, you sell it in the market and you get U S 0 amount of money. So, you get U S 0 amount of money with the probability Q u and you get 0 with the probability of Q d. So, this is what the expected value of cash inflow is, and e to the power minus r t gives you the present value of this expected value. So, in the price of the call, which we saw was this quantity, is nothing but the present value of the cash inflow minus the present value of the expected cash outflow. Present value of the expected cash inflow in terms of the receipt of stock minus present value of the expected cash outflow in terms of the payment of exercise money, and that is nothing but the present value of the expected value of the net cash flow. So, what have we concluded? We have concluded that the value of the call is the present value of the expected value of the net cash flow under the option. Now, so far we have talked about the single period binomial model. Now, as we discussed in the case of random walk, this is probably the simplest scenario where we encounter stochastic processes or where we encounter volatility or where we encounter randomness in terms of movement with respect to time or unpredictability in terms of flow of time. But life is not so simple, the world is not so simple, physical processes are not so simple, financial processes are not so simple. So, we have to extrapolate on this. Let us now move to a 2 period binomial model. Now, instead of going into the nitty gritty of calculations and showing that the single period binomial model can be extended to the 2 period binomial model and then to the n period binomial model by virtue of mathematical induction, similarly like we do for the binomial theorem, in fact it is very similar to that, but I preferred to take up an example to illustrate that the above principle also holds in the case of a 2 period binomial model. So, let us do this example. This will illustrate how the 1 period binomial model or single step binomial model can be extrapolated, can be extended to more than 1 period. So, let us do this example. What do we have? We have a 2-year European put, with a strike price of 52 and a stock, the underlying asset, whose current price S naught is equal to 50, K is equal to 52, and S naught is equal to 50. The price jumps are by 20%, in other words the price could go to 120% of this, or the price could go down to 80% of this. At each step, remember this is important, it could either moves up or moves down. At each step it goes either up by 20% or goes down by 20%, and the risk free rate is given as 5%. We need to calculate the current value of the option. I repeat, the information given is the exercise price is 52, the current stock price is 50, the upswing and downswings are the stock price, current stock price can go up to 120% of its current value, or it can go down to 80% of its current value, and this can happen in 2 steps, one step at the end of 1 year and the second step at the end of the second year, and the risk free rate is 5%. So, this illustrates the model or the data. 50 is the starting point, A is the starting point, the current stock price is 50, From here the stock price can go up by 20%, that is it can go to 60, or it can go to 40, go down by 20%, that is either it goes up to 60 or it goes down to 40. Remember, we are not given real world probabilities, please note this point. It goes either up to 60 or it goes down to 40. In the second step, from 60 it can again go up 20% to 72, or it can go down 20% to 48. Similarly, from 40 it can go up 20% to 48, and it can go down 20% to 32. Our problem is to work out the value of the put option having an exercise price k of 52 with a risk free rate of 5% per annum, of course. Now, let us first work out the payoffs. Remember, it is a put option. A put option, it has the exercise price of 52. Suppose the stock price is 72. So, if the stock price is 72, will the put option be exercised? Put option is the right to sell. Now, market price is 72, exercise price is 52. You would rather sell in the market than selling under the put option. Therefore, the payoff from the put option will be 0. Now, if the stock price is 48, what happens? You do exercise the option, because the market price is 48. If you sell it in the market, you get 48. If you sell it under the put option, you get 52. So, therefore, the payoff of from the put option is 4. And similarly, if the market price is 32, you will surely exercise the put option, because you will get 52 under the option contract, but if you sell in the market, you will get only 32, and as a result of which your profit under the put option or the payoff under the put option is 20. Right. So, this is the situation that we have. Payoff at point D is 0, payoff at point E is 4, and payoff at point F is 20. We have to work out, we have to work backwards. We have to arrive at the price at points B and C, and then arrive at the price at the point A, which is the figure that is finally required. Remember, it is a European option, European put, and therefore, it cannot be exercised early. In other words, it cannot be exercised at point B, it cannot be exercised at point C, and it can also not be exercised at point A. It can only be exercised at the end of 2 years from today, which is in the at this represented by points D and E and F. Let us see the workings. U is equal to 1.20 in this case, as I mentioned just now. D is equal to 0.80, because the price can go up by 20% and go down by the 20%. Therefore, either the stock price goes to 120% of its current value, or the stock goes down to 80% of its current value. So, U is 1.20, D is 0.80. Time for one step is 1 year, and R is 15%. The risk neutral probability for an upswing, QU, please note this, we are working in terms of QU. So, QU is the probability of an upswing, that is given by e to the power RT minus D upon U minus D. We have got this formula earlier, we worked it out. So, using this formula, we arrived at this value of QU 0.6282. Therefore, QD will work out to 1 minus this figure 0.6282, and that is equal to 0.3718. I hope my calculations are correct, but I think so. Now, the stock prices at various notes, we have already discussed that. Claim values at various notes, we have also discussed that. So, we move on to the next slide. The claim value at the end of the first step. We remember, we are moving backwards. We are moving from the nodes D, E and F to nodes B and C. So, we are moving backwards. Now, we are working out the value of the claim or value of the option at the point B, which is the upper node at t equal to 1. T equal to 1 year, the upper node is B, the lower node is C. We are working out the value of the option if the stock price goes to node B. So, that will be equal to e to the power minus RT, because it is 1 year, each step is of 1 year. So, it is e to the power minus RT. Q FUU, what is FUU? FUU is the claim when the node is D, that is FUU, when there are two up steps. First step is also an up step, the second step is also an up step, which is node D. plus 1 minus q f u d. That means, the first step is an up step, you move to node B, but then you move down to node E. The second step is a down step. So, first f u u is the value of the claim when the stock price is at D, and f u d is the value of the claim when the stock price is at point E. Substitute the respective values, f u u we have worked out as 0 and f u d we worked out at 4. The respective probabilities also we have with us, and we get a value of 1.4147, which we have noted down in the graph, in the diagram as well. This is 1.4147. This is the value of this put option at the node B, at the node B. Now, let us work out the value at the node C. At the node C, what happens? At the node C, the first step is down, and then the second step is either up or down. Therefore, working backwards, the either you are at E and you move down to C, or you are at F and you move up to B, up to C. Remember, either you are at E, you are moving down to C, you are moving backwards now, you are at E and you are moving backwards to C, or you are at F and you are moving backwards to C. In other words, from C, looking at it in the other perspective, in the proper direction, from C either you have moved to E or you have moved to F. There are only two possibilities. Once you are at point C, you have either moved to E or you have moved to F. If you moved up, you have moved to E. If you moved down, you move to F. So, the corresponding claim values are f u d, that means, in fact, f u d is nothing but f d u. First step is down and the second step is up, that is point E. First step is down, that is point C, and second step is up, which is point E. So, the claim value at point E, which is 4, and the other one is f d d, which is point F. First step is down, second step is down, and at that point the claim value was 20. So, 20 into this value plus 4 into this value. Why we have got this value? Remember, the point E, let me just quickly draw this here. This is point E, this is point F, and this is point C. So, from C, if you are moving up, the probability is 0.6282, and the value of the claim here is 4. From C, if you are moving to point F, you are moving down, the probability of this is 0.3718, and the value of the claim if you reach point F is 20. Therefore, the expected value of the claim at this point with discounting, this is discounting, please note. So, with discounting is given by 4 into 0.6282 plus 20 into 0.3718. That comes to 9.4636. So, that is the value of the claim if you are moving backwards to point C. In other words, this is the value of the claim at C, this is the value of the claim at B. Now, we move further backwards to the next step, which is our original step, and we work out the value as of today, which is the point A. We work out the value at point A. Now, at point A, what happens? Point A, this is my point A. From point A, either you can go up to point B or you can go down to point C. The probability of this is 0.6282, the probability of this is 0.3718, and if you are at point B, the value of the claim is 1.4147, we just now worked it out, and if you are at point C, the value of the claim is 9.4636, and therefore, the value of the claim at point A is given by 0.6282 into 1.4147 plus 0.3718 into 9.4636. Discounted to because there is a time gap between them of 1 year, we discount them for 1 year and we end up with a value of 4.1923, which is the value of the claim This is the current value of, in other words, this is the current value or today's value of the put option on the basis of this two-step binomial model of a 2-year put option with an exercise price of 52, if the current stock price is 50 and if these price jumps are in terms of 20% per year, if the risk free interest rate is 5%, given the set of data, today's price of the put option is 4.1923. Right. So far we have talked about the valuation of a European put option, a European option. Remember, European option is an option that can be exercised only on the maturity date, it cannot be exercised earlier. However, in the case of an American option, it can be exercised at any time during the lifetime of the option. Therefore, in the case of the American option, what will happen is, let us look at this same option. It has a strike price of put option. It has a strike price of 52, life of 2 years, 2 time steps of 1 year, and the risk free rate is 5%, and the jumps are in terms of 20%. Jumps are of 20% per annum, of course. Each year it can jump, the data is same as in the previous case. The only difference is, in the previous case it was a European put, here we have an American put. Now, in the case of the American put, what happens? American put option can be exercised at any point between today and maturity. Therefore, because the American option can be exercised at any time before maturity, what is the difference that will arise when we do the valuation compared to what we have done just now? The difference that will arise is that we have to examine the possibility of early exercise. In other words, we have to examine whether it would be profitable, whether it would be appropriate for the investor, for the party holding the long position in the option, to exercise the option at the point B or let it continue, point C or let it continue, or even point A. Whether as of today I would be better off exercising the option because I have the right to exercise an American option. So, I can exercise. So, we have to examine that possibility whether I can exercise the option, that is the question. That is the difference between the valuation that we have done for the European put and the American put. How does it manifest itself in the analysis? That is the next question. What it does is, we just worked out the values of the option at the point B and C. We found that the value of the option at the point B was 1.4147 and the value of the option at the point C was 9.4636. We got this from the previous example. Right. Now, suppose I exercise the option at the point B, the stock price is 60, the exercise price is 52. So, what would be the payoff from the option? Is it worthwhile exercising the option at point B? It is not worthwhile exercising the option at point B. Why? Because the stock price is 60, the payoff, the strike price is 52. So, the payoff would be 0. Whereas, if I do not exercise the option, I still have the options market value is supposed to be 1.4147. So, I would rather remain invested than exercise the option. Now, let us look at the second scenario, case C. In the case of C, what happens? In the case of C, the value of the option arrived at on the basis of analysis is 9.4636. However, if I exercise the option, I find that I get a payoff of 52 minus 40, that is 12. In other words, what will happen? What I am saying is that if the stock price goes down to 40 at the end of 1 year, I would be better off exercising the option rather than retaining the option for future use. I should rather exercise the option if the stock price goes down to 40 instead of 60. So, what does it mean? It means that the value of the option at this point, at the node C, is precisely not 9.4636, but it is equal to its intrinsic value, which is 12, and we therefore we substitute 12 instead of 9.4636 in our calculation of the value of the option at point A. And when we move over to point A, what do we find? We find that at the point A, what happens? At the point A, the value of the option turns out to be 5.0894 instead of 4.19, which we did earlier, because of this change. Because this option can be exercised early, and by exercising early we get a higher payoff than what is its theoretical value. We use we substitute the intrinsic value for the theoretical value, and because you see, the value of the option cannot be lower than what I can get by immediately exercising the option. Remember, it is an American option, so I can exercise the option immediately. And if I exercise the option immediately, I get a sum of 12. Therefore, the value of the option cannot be less than 12, and hence I make the substitution as 12 instead of 9.46 and arrive at the figure of 5.0894 at point A. I also have to examine the possibility of early exercise at point A. Point A, the stock price is 50 and the exercise price is 52. Therefore, the payoff is only 2. The intrinsic value is 5.08, therefore, early exercise at A is not advised, and hence the value of the option is this. The final value of the option as of today is this figure. If it is an American option, 5.0894. Please compare this with the value that we obtained for the European option of 4.19. The value has increased because of this particular factor. Thank you. We will continue after the break.